let's try and explore this space together. Because it's fascinating, and this is something that I experienced as a young person as well. When anyone talked to me about the financial services industry, my impression of financial services was banks. What does my father do when he earns a salary? He goes and puts it in the bank. Life carries on, and we get on with our day to day. But as I grew up, and eventually my career brought me to the financial services industry, ironically, a little over 20 years ago was when I first actually became a financial services industry professional, a few years after I graduated from my undergrad, my engineering course. And when I came to understand the industry in its nuances, I was reminded of this image that you see in the background, the legendary story of the three blind men and the elephant. I don't know if you've heard of that, but the story goes that people visually impaired came to see an elephant, though all of them were blind, and each of them reached a different part of the elephant, touched it, and one person thought it was a spear because he touched the trunk. The other thought it was a snake because the tusk. The other thought it was a snake. The third thought it was a pillar. The fourth thought it was a wall, because each of them approached the elephant from different sides. And the poem that was written by an English poet called, I think, Geoffrey Six, if I'm not mistaken, ends with a very beautiful line that says, "Though each of them was in the right, they all were in the wrong." Often, we are all right about our understanding of the industry, but there are so many facets to it, which I'm hoping that in the course of this conversation, we can bring together so that at least as you plan your careers, you have a sense of how the financial services industry interconnects with each other. Now, to do that, what I will do is use the oldest skill of all. I'll tell you one story. Now, this story has two branches. So I'll tell it in 3 episodes, and then we'll have an epilogue. And hopefully, with that, you should be able to understand uh, just how the financial services industry functions. But to give you context of where the story begins, I call the story of risk. Because financial risk primarily is a very interesting, very nuanced thing. A company that sets itself up in order to do a certain business accepts and wants to take a certain calculated risk. But at the same time, there are some risks that they do not want to take, but they come as par for the course. If you think about these two kinds of risk, and we'll look at a concrete example as we go along, but if you think of these two kinds of risk, that opens up an understanding of the financial services industry and how some risk is taken, some risk is passed on, and eventually where does that go and reside, and how do different parts of the financial services industry as a whole contribute to that, right? So let's start with the story. Episode 1, preventing risk. Now, let's think of the risk that a power company faces if it is trying to import coal, a shipment of coal from Australia to India. It's coming by the sea. Why Australia? Because they produce the highest quality of coal out there. Why India? Because that is where the power plant is, right? So it's an input that is important to the company. A lot of its business and a lot of its profitability is impacted by what kind of coal comes in. Now, as this coal is sailing down the open sea, let's say the ship encounters a storm. Maybe it's not a storm that might threaten the entire ship itself, but it might even cause it a delay. But that delay has an impact because that creates risks that the company did not really want to take. The company wanted to get coal, put it in their power plant, make their power, sell the power, and the risk that they want to take is that people may or may not buy that coal. This risk is that because of this 1 month's delay, the price of coal itself might change. And we've seen coal markets have wild swings within a month. All kinds of markets move to the very complicated supply and demand scenarios all around the world. And so markets could move in a way that you never expected. And therefore, if commodity prices, in this case specifically coal prices, move, the company might lose more money than it intended to in the beginning. At the same time, they are buying in Aussie dollar, but they're using in Indian rupee, which means that they have to factor in that currency exchange rate as well. What happens in Australia as a result of their interest rate environments and the value of their currency? What happens in India as a result of our own interest rate environment? What is happening in the global markets and especially in today's tariff special age, it's very tough to say what factors can tend to influence the markets, but it is important to learn to react to them. So these are two risks that the company did not sign up for, but it has to manage. And so, what does this company do? The corporate treasurer of this company looks at the risk, tries and understands what are the various inputs and what are the various likelihoods of how the prices of these two, the commodity and the currency, might move. And once they have a sense of what their risk or their likelihood is, they reach out to their banks. Now, typically, it's not just one bank. Every large corporation, especially something as big as a power plant, will have several banks empaneled, and they will try and reach out to them to ask if they can sell them some sort of an insurance against the risk, a protection against the financial risk of the move of these prices. There are mechanisms which we'll not go into details of now, but this is something you will explore as you learn about each of these companies and how they interact with each other. But the company reaches out to its banks, says, hey, here is some protection that I require to purchase. How much will you sell them to me for? The banks then look at this request for quote, it is called, that comes to them, and they calculate with their internal systems and try and figure out what exactly these risks might be. And if they feel that the risk is something that is something they can digest, they then say, okay, fine, we will take this risk from you by selling to you some sort of a derivatives instrument. Now, this could be a future, a forward, an option, or a swap, which also, since you are planning a career in the financial markets, you will learn as you go along in your courses. But for now, suffice to understand that they will sell them this product by attaching a premium to it. So it is like an insurance policy where you purchase an insurance policy which triggers in certain events. And if it triggers, then you are protected against the risk that you had bought this protection against, right? So that is how banks sell a form of protection to the company, and the company is able to then offload this risk from their own books, the financial risk, from their own books over to the books of the bank. But the bank is not in the business of taking risk. And no one explains how banks deal with all this risk they collect from all the companies around the world better than the great Margot Robbie herself. If you have not done so yet, please watch the movie The Big Short. This picture on the top of the slide is from that amazing movie, in which, in this very short clip, Margot Robbie talks about the process of securitization and how banks that purchase risk from various different sources can bundle them all together and slice them up into different kinds of instruments. You've heard of things like collateralized debt obligations. You've heard of many other exotic products, which these banks, via their interbank brokers, sell to investment managers. Now, typically, these kind of specialized products are purchased by investment managers that have a higher risk appetite. You might hear of things like hedge funds, quant funds, etc., that that are looking for interesting kinds of risk that others might not be able to understand much, but they are able to bring a lot more, let's say, rigor into their analysis, and therefore are willing to buy. But the risk essentially comes from the company to the bank bundles it, and with the help of interbank brokers, passes it on to the investment managers. That is one journey that this risk has taken. Remember, I told you this was episode 1, the risk that the company wanted to avoid. But then there's the other risk, the risk that you need to take in order to grow. And to grow, you need to raise capital. So how might a company possibly raise capital? There are several ways, but typically the simplest understanding of that would be they can either take a loan, some sort of debt, by issuing corporate bonds or just a direct loan from a bank, or they can sell a portion of themselves. If they're selling a share of the company for the first time, it is called an initial offering. If it is selling a follow-on offering, it's called an FPO. So these are a couple of ways in which companies can raise capital. But this company, our power plant in this case, is not in the business of thinking of what kind of exotic products they might want to sell. Let me rephrase. This company is not in the business of creating financial products and selling them. This company is in the business of buying coal, putting it through a power plant, generating power, selling that. So they reach out to people in the industry who have expertise in this space. Those typically are investment banks. Investment banks, you will have heard of a lot of these, the names such as Goldman Sachs and JP Morgan at the global level. You might have heard, for those in India, you might have heard of entities like JM Financial or Motilal Oswal. Companies, financial services companies have investment banking businesses at all sizes that work at all kinds of levels of sophistication. Some are sector specialists, others are specialists in a certain kind of instrument. Either it could be a debt offering or an equity offering, and so on and so forth. And each develops their own niche as they go along. Some are huge, some are small, but each of them essentially help companies raise capital so that that capital can be invested for whatever the company's agenda is. And from there on, once, let's say in this case, we are going with the example of stock, the investment banks working with institutional brokers will either sell it directly to money managers. In this case, money managers are folks like mutual funds, insurance funds, pension funds, larger, slightly safer playing money managers that mostly invest in either stocks or government debt, which is usually known to be safer than corporate debt or even corporate debt, but relatively familiar, safer instruments, right? So they would either um, directly place this, do a private placement exercise to give this money to these large investment managers, or alternatively, they might help the company to list their stock on an exchange. And once it is listed on the exchanges, institutional brokers can still help these large fund managers to purchase large blocks of shares from the open market, or retail brokers also help individuals to trade in this market. So I hope you've gotten a sense of now this desirable kind of risk. What happens in this case is that people, companies that want to raise capital reach out, and then there is a certain series of mechanisms through which money comes to them. But you realize that money is not printed out of nowhere. We talked about investment managers, we talked about brokers and such entities, but none of these create their own money. Where does that money come from? The real hero, look at the bottom of the slide, is the individual investor. The individual investor, folks like you and me, folks with more money than you or me, folks with less money than you or me, but each of them in their own capacity, with their own risk appetite, with their own needs, try to protect their capital against market risk and try to maximize the value coming out of their capital. And in order to do that, you have the parts of the industry that reach out to them in order to take their money and then pass it on to places that it can be used. So you have the hedge funds and quant funds of the world that often directly reach out to very large, high net worth, ultra high net worth individuals. You have the large institutional brokers that buy and sell stock for investment managers, and investment managers create these funds that are then either directly sold on the open market or sold through distribution agents of different kinds. In fact, the State Bank of India is the largest mutual fund distributor in India and arguably the world as well. That's a very fascinating insight that I found out. But this is how the individual investor is the one. So people from around the world who gather, earn their money from all the work that they do. And then the financial services industry takes that money and channels it to places where risk can yield return. But that is how money flows across the industry. So I hope this makes sense. We started at a company that either wants to take risk or wants to avoid risk. When it wants to take risk, there is a certain channel for risk to flow and money to flow from an end investor to them. And when they want to avoid risk, there is a certain way that they can push that risk off to others. And there is a mechanism for that to also eventually reach the end investor. But I hope you see the web. This is what we traditionally know as the financial services industry. But this is not the entire financial industry. And that is a very important distinction to understand. The industry also has a lot of players who are watching it and trying to understand and decipher the market for various different agenda. These watchers, I broadly believe, are of four types. One is academia. For everyone who's a student right now, uh, we are looking at folks who um, understand the markets, your professors, for instance, in order to help you understand what how does the market move, how do the various roles of the various participants in the markets operate, so that you can then build a career within these and help to take this, keep this machine churning forward. At the same time, media houses try to make sense of the markets in order to help people understand what exactly is going on in this space. While the very sophisticated end investor might have very fancy tools, if you might, in order to make sense of the markets, several end investors who have lesser means only rely on the information that comes out from the CNBCs and the Wall Street journals and all of the world. Then you have the fintech space. Fintech is a very, frankly, overly abused term. It manifests in many, many different ways. But broadly speaking, companies that create products and services that either accelerate or lubricate the functioning of the industry as a whole that we talked about, or companies that that help people to transact with the markets directly. So whether it is trading or it is building your own little investment portfolio of different kinds of products, asset diversification. In the end, people who want to protect. So there are several uh, different ways in order to in which fintech companies serve the industry. But in the end, all they are doing is using information technology to make the flow of information and processes faster and smoother. Now, this entire space is watched by the group in the bottom right corner, the regulators. Now, regulators are of all shapes and sizes. Um, Central banks of countries regulate their banking system. There are separately capital market regulators like the SEC in the US or in the Philippines, the Securities Commission in Malaysia, the SEBI, Securities and Exchanges Board in India. And each of these entities pays attention to the capital markets with the primary intention being of protecting the end investor. But in order to do that, it also regulates the intermediaries of the industry. So all of the companies that I talked about so far fall under the ambit of these regulators. In fact, very fascinating that now the regulators, and I completely agree with them, are also looking to pay attention to social media, to the finfluencers in this space, because this has become a very dangerous, a very toxic space. For those of you who look for information and guidance in the wider market, and I'll talk a little more when I come to CMT Association, what we do and why we exist. I'll talk a bit more about this. But understanding this becomes incredibly important because you need to have a sense of what is good and bad quality information as well. There are too many people out there who convince other people, more innocent people, that money can be made very easily off of the markets, and therefore make most of their money not by actually investing, but by teaching, quote unquote, other people to invest. And just in fact, this afternoon I was talking to a senior official in a large discount broking house based in India. And the conversation was about exactly this, about the danger of the finfluencers. And I'm deeply in agreement with what the Securities and Exchange Board of India is doing to control this menace. But the key takeaway for especially all of you who are planning to have careers in finance is please learn to form your own opinions. There is no easy way to invest and to make money, right? So, if I'm being so grim about this, and if this is the nature of the financial services industry, where does that lead you? Or how do you find your place in the industry? So, even before we go into what kind of skills you require for this, let me give you a sense of all the different types and subtypes of companies that I told you about, right? So I've talked to you about corporations that have their own corporate treasuries. I've talked to you about brokers of all kinds, whether it's investment banks or banks themselves that move money from one place to the other. I've talked to you about investment managers of different shapes and sizes, and the end investor. Now, if you think of all kinds of companies, and because most of you are planning to be professionals in the financial services industry, all kinds of companies, you need to understand, have three different slices of the firm. I don't know slices is the right word, but there are three layers, if you might. The front, mid, and back office. I'll start from the bottom. The back office is the operations of the firm. Think of it as the skeleton of the organization, the backbone. It is what keeps the organization operating. Everything from accounts and operations and IT and bookkeeping and the management of the data and all of that comes as part of the back office service. Incredibly essential, and it has its own part to play in an organization. Then there is the mid office, the conscience or the heart of the organization, in the sense that if an organization is bound by the rules of the industry or the sector, subsector, or even their own rules that they've decided to participate in the industry with. Let's take, for instance, a very popular mass market mutual fund. Typically, by mandate from the government, is restricted from investing in several kinds of instruments. These large mass market mutual funds are not allowed, for instance, to invest in cryptocurrencies or in futures and options, or even are not allowed to short sell or aggressively bet on a downsliding market. They're expected to be long only, so they can only get out of a position in order to buy into another position. So these are all rules. Either the company sets rules for itself, like let's say if I, as a mutual fund company, launch a fund that says I am a large cap long only fund. Those are rules I've set for myself, and at the same time I have to also follow the rules that the government or the regulator sets for me. The mid office makes sure that I follow all those rules, right? So in that sense, it is the conscience. It's trying to keep the company within the lane that the company has chosen to be in and what the company is regulated for, right? The front office is the face, the brains, the hand and feet of the organization. So when you ask the question, what does this company do? What the front office does is your answer. A broking company is there to help facilitate an investor and an exchange, for instance, or an investor and another investor to transact with each other. That is their business. In order to do that better, they also offer research services. So that is also their business. That is the work that they do. So the front office is where the decision making happens, where the market analysis happens, more often than not, where the leadership of the organization comes from, right? And this is where all the investment management studies, etc., comes to people, to the participants of the industry. So even when you, as you are planning your careers, decide that you want to do some sort of professional certification, it would help for you to understand, given the map and the different types of companies within an industry I've told you about. Let's say, what is your temperament, first and foremost, and two, what kind of roles would you like to do? If you are looking for a back office role, then qualifications like CA, Chartered Accountancy, ACCA, CMA, CIMA, all these accounting and actuarial kind of roles would be of value to you. In the mid office, you're looking at qualifications rather, like FRM by GARP, or like Premia, PRMIA, that's another one. There are several mid-office qualifications, or mid-office risk management qualifications. Actuarial kind of in the insurance industry flits between these two. In the front office, especially where strategic leadership and investment decisions are made, there you are looking for skills and qualifications such as the CFA if you are looking at the world of fundamental analysis, CMT if you're looking at technical analysis, and then as you progress in your career, if you are going to narrow into the world of, let's say, asset allocation, then you're looking at CAIA. In some jurisdictions, in some countries, especially those that come under British common law, the CISI it's not strictly, but kind of an equivalent of the CFA in terms of the breadth of what it covers. So there are different qualifications that would matter. But what I have come across as a global consensus is that learning these skills in a way that matches with your career aspirations or where you want to head is incredibly valuable. And understanding the markets in a way is a skill that everybody should have, right? So, with that in mind, what I'm going to now talk to you about is technical analysis specifically. I'm seeing some questions go by about whether this is a fundamentals or technicals course. When talking specifically about the CMT program, that's about technical analysis. We'll come to that in a bit. Ria, am I teaching fundamentals? What I'm talking to you about right now is fundamentals of the industry as a whole, just for you to get a sense of what this financial services industry is. Because, funnily enough, the skills of technical analysis specifically, but technical and fundamental analysis, if you are looking for front office roles across any kind of company within the industry, are incredibly valuable. Um, think of it this way: roles that you might not have considered. Now, I'm assuming most of you like coffee, and most of you have been to a Starbucks. If you've been to a Starbucks in India, there is a very good chance that the coffee you've had, the beans for the coffee that you had, were purchased by a CMT charter holder managing the Tata Coffee / Starbucks treasury out of Bangalore. So it's not necessarily just traders and investment managers, but also treasury managers, procurement folks. One of our board members works for a consulting firm. There are economists and strategists as well and everybody learns technical analysis from a slightly different perspective. But let's try and understand what technical analysis is in the first place. And again, I'll take one step back, and Vishwa, I'll come to your question as well. But I'll take one step back to talk to you about what kinds of analysis or what kinds of data is available in the first place about the industry, right? So if you look at this slide right here, there are two ways of trying to make sense of the price of any security. Now, this security could be a stock, the price of a share. It could be the price of a bond, the price of a commodity, whether it is metals like copper and aluminum and iron, or precious metals like gold, silver, etc. I don't know if you're paying attention right now to gold markets, or even for Vishwa, cryptocurrencies, and what is the intrinsic value. So the price is something that is analyzed from multiple angles, mainly these two angles: the angle of intrinsic value and the angle of market price. Intrinsic value tries to understand what should the price of this be right now. What is the price of what are the various factors that go into making up this price? For instance, if it is a company, let's say it's a company that makes smartphones. What are the input costs of this company? What are the various materials it buys? What are the markets it operates in? What has the sales been for a while? What are the sales likely to be in the next few years? Who is this company competing with? What side of the bed did the founder wake up in? There are all kinds of questions that you will need to bring into consideration to try and get a sense of what should the price of the share of this company be. That is one side to it. But the other is what a price should be and what a price is very rarely in the same place. Because markets are, by their very definition, inefficient. Information does not flow at the same time for everyone, contrary to the popular hypothesis. And because markets are not perfectly transparent, perfectly efficient, the price that an entity currently trades at does not always and necessarily match with the intrinsic value. Understanding the gap between intrinsic value and market price is what technical analysis does. So what it does is, irrespective of what the value of a stock or a commodity or a bond or a currency should be, it looks at what is the price right now. And it tries to understand where is the price in the context of where it has been in the recent past. And is there a momentum in the movement of the price, either upwards or downwards, or is it moving sideways? And through that, it helps to fill the gap between what intrinsic value leaves behind. Because it takes into consideration not just what the price should be, but what do people feel that the price should be. Some people believe that the price should be higher, that is why they buy. Some people believe that the price should be lower, that is why they sell. And it is the interplay of this buying and selling, supply and demand, that moves markets the way it does, right? So I hope you get this conceptual understanding of the markets. From here, we move on. A lot of people, when you talk about technical analysis, think of it as charts and charting. It is right, but like the elephant, it is partly right. Charts and charting became the primary way of developing and practicing technical analysis because the discipline itself is a few hundred years old. And back in the day, drawing out points of where the price has been in the past on a time on with time as the x-axis was the only way that you could get large amounts of data into a small space so that it could make sense, right? And therefore that became a way of trying to make sense of that data. And as the ways of storing the data and understanding it and manipulating it got more and more sophisticated, larger and larger amounts of data could be processed. Technical analysis left the charts, although many people still use it, but and became the realm of mathematics and statistics, which it actually is. And today, this mathematics and statistics happens not only on paper, but also in microprocessors around the world. In fact, I myself am doing a doctoral course right now that is at the intersection of artificial intelligence, technical analysis, and strategic decision making. So there's a crazy amount of stuff going on, and something like technical analysis, which gives you readily accessible data, because all exchanges provide publicly traded market data practically for free, and the tools to do technical analysis also are practically for free. Unfortunately, that is the problem. That because people think that the data and the tools are free, that the skill comes automatically. And that is what CMT Association tries to address. But we'll come to that in a second. Right? Now, why I personally believe in technical analysis has more to do with just building a career in the financial markets. Now, all of you, irrespective of where your career ends up, will inevitably earn money, or at least so I hope. And if you earn money, you will want to protect it against at least inflation. And in order to do that, you will have to invest your money. The least you can do is to learn how to protect yourself. Now, this is incredibly important because let me do a quick highlight reel. I graduated at the peak of the dot-com bust, 2001, and everybody who had gotten campus placements on my campus lost their jobs. So we had to take whichever job we got, right? And for the next couple of years, most of my cohort mates kind of managed somehow. And then for folks who probably entered the markets even 2 or 3 years after us, from say around mid 2003 all the way to early 2008, the markets just went one way, right? So everybody thought that is how investing works. You throw money somewhere in the markets and it just runs off. And then for those of you who have read your history, the global financial crisis happened. I mean, for you, it was history. For me, it was current affairs. And that happened. And over the next year, the markets practically halved, right? And then after mid to late 2009, for the next 10 years, the markets went in just one direction, barring some minor blips. So everybody thought that no matter where you throw your money in, the markets just keep going up, 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 and up. And then all of you are old enough to have seen March 2020. I don't know if you were paying attention to the markets then. But in March 2020, in 1 month, the markets lost 40% of the value. I'm taking Nifty as an example, but all markets around the world suffered kind of the same thing. And that showed us how vulnerable we are all to markets all the time. So the point I'm trying to make is that in my career of only 25 years, I've seen 3 major market shocks, apart from, of course, shocks that come and go. Crypto came and went and came back again and stuff's happening. And there are different asset classes where rises and falls will keep happening. So it's very important to understand and pay attention to what is happening in the markets at all times so that you are always in a position to protect yourself against it. Right. So with that in mind, what I want to say to you is that learning to understand how to time the markets, understanding that there is a bad time to buy a good stock. There is a good time to buy a stock whose fundamentals might not be great, but not something I advise. The other thing is how to protect your capital, how to get out of the way of a falling knife. I'm not showing you charts right now because I want you to understand conceptually what that means. March 2020, experienced money managers also froze, and many people that I know personally experienced career professionals with decades of experience, got out of the markets literally at the bottom when the markets had crashed 40%. And then they were so scared or scarred at that time that they did not manage to re-enter for the next at least 8 to 9 months. And in those 8 to 9 months, the markets retraced the entire loss and then went on making all-time highs for the next till September 2024. The markets was just going one way. These are things for you to understand. Shocks will keep happening. Markets will keep moving. Learning to have a set of rules which give you the discipline to navigate these markets is not just a career skill that you will use for your clients. It is a personal life skill for everyone to have. So that's just a point that I make sure that I underscore very hard. But then technical analysis is also the only lens you have into understanding what does the market say? What does the market feel at this point? Is there pressure towards the bearish side, or are more people looking to sell than buy? Are more people looking to buy than sell? What does that mean? How does this interplay of supply and demand move prices in a way that creates certain patterns that tend to repeat itself in the price? And how do you adapt to it? How do you understand how to react when these patterns start making themselves visible? All of this is not prediction, please understand. All of this is trying to understand probabilities. You will, as you go along, you will hear concepts like relative strength, market breadth, divergence, and so on and so forth. And each of these are different ways of trying to make sense of the markets to primarily understand, does the market currently have momentum in an upward direction, a downward direction, a sideways direction? And then based on my investment objectives, how do I react to it? And this comes back to, Vishwa, your question, that yes, this applies to every single asset class. As long as there are enough human beings trading it, as long as it's liquid enough, whether it is FNO or crypto or your spot currencies or what you call physical commodities, anything, as long as there are enough human beings trading it, their technical analysis makes sense, because technical analysis is understanding behaviors, the push and pull of supply and demand. It is not trying to say, why is the price this? It is just saying that because the price is at this point and moving in this direction, here are the actions I can take. And if my thesis, my belief does not pan out, here is how I can react to protect myself from any untoward market risk. I hope this makes sense. And like I said, we are reaching the end of this part of the spiel. So if you have any questions, please start putting them in the chat right away. We can start taking them. Now, what's in it for you and why is this conversation happening with you? So let me introduce you to CMT Association, the Chartered Market Technicians Association. Some of you will have probably looked at it. It completed 50 years at the time of this picture. This picture was the board of directors of CMT Association invited to the New York Stock Exchange to ring the closing bell to mark 50 years of contribution of CMT Association. This was April 2023. 50 years of our contribution to the financial services industry, starting from Wall Street. And today we have members in over 120 countries around the world. It's an amazing organization because it's an organization where people are dedicated to advancing the discipline of technical analysis. And the CMT designation has been respected for now at least 30 years. It was conceived in the early 80s and formally launched in 1989. And since then, now it has become the foremost credential for technical analysis in the world. So, yes, the CMT program is essentially a 3-level program. Levels 1 and 2 are MCQs, and level 3 is short answers. Level 1 is a 2.5-hour question exam. Level 2 and 3 are 4.5 hours. All of this information is available on the website, so I will not give you the obvious. Please, if you are interested, do visit the website. I recommend that you do be interested because, and I will talk about the academic partner program in a sec, of why that matters to you at this point. But let me take a few questions that I can see coming up. Agam, CMT is a super specialized course. Is there a job market for a bachelor's with CMT charter? The quick answer is yes. The more nuanced answer is that technical analysis is a skill that can sit on top of anything that you do in the financial services industry. So think of it as, if you pick an industry that is of value to you, and if within that you think that a front office role is where you want to end up, technical analysis gives you a leg up over someone who does not have that specific skill set. Having said that, because it is such a diverse skill, it is for you to decide exactly where you want to develop that skill, as in what kind of industry or role you want to work in, and then work towards building a body of work. uh, but the simple answer is yes, we always keep getting companies reaching out to us and inquiring for, especially like I said, front office roles where there are uh, where there's a requirement for either facing the markets to analyze them, or facing customers to explain your analysis of the markets, right? So super specialized course, it is specific to a domain, but that domain is extremely fungible, so it fits across, like I said, any aspect of the industry. Case in point, 2nd of October, Charles Schwab, you must have heard of the Charles Schwab Corporation. It's I think the world's largest broker dealer, especially the world's largest retail broker. The CEO of Charles Schwab is also a CMT charter holder, and they're doing. It's funny, they're doing a CMT association network within Charles Schwab itself, and they have their own exclusive group of people. And the CEO and one of our board members is having a fireside chat for this community. So it's a very fascinating space. But many companies are increasingly adding the magic word CMT preferred in their job requirements, especially for front office roles. But um, Swapnil, to your question, is CMT the only way to enter the technical analysis job market? Absolutely not. CMT is a way of distinguishing yourself. Because, like I mentioned earlier, right, the tools and the data are available practically for free. So, how do you prove to someone that not only do you have the tools and data, which everybody does, but you also know how to use them? You also know how to make sense of them. So, if you are able to say, as you start your career, that you cleared levels 1, 2, 3 successively are of value, and then eventually you go on to earn your CMT designation, that proves that you have, I would argue, the intellectual firepower and the rigor to not only clear this fairly challenging set of exams, but also to understand the markets, understand how to be a professional in the markets. And therefore, people value anyone who has the word CMT against their name. Now, very recently, CNBC Arabia invited, it's been doing the series, and you'll probably see videos about it. I mean, it's in Arabic, but with subtitles. You'll see videos about it on our YouTube channel as well. But they've been inviting CMT charter holders specifically from around the world to offer their market commentary on what's going on in the financial services industry in the GCC, that's the Gulf Cooperation Council region. Ria, can we analyze the markets after the CMT course? Yes, absolutely. In fact, as you'll go through the program, clear level 1, level 2, level 3, your ability to make sense of the markets, both broad markets across all securities and across sectors, across geographies, etc., and individual securities and its price action, that is what technical analysis is all about. The CMT exams test you at successive levels 1, 2, and 3. Level 1 is more definition in nature. Level 2 is application. How do you take all these skills and apply them? Level 3 is how do you integrate them to actually form meaningful decision-making systems. So that is what, for instance, folks who build their own algorithms, folks who build quantitative systems, etc., benefit a lot from this in their management. What is okay? Another good one. Oh, I can see Agam, you are taking level 1 in December. Brilliant. Well done, you. Megnath, Rapol Megnath, or Rapore. What is the relevance of Python programming in CMT? Very good question. Now, what is the relevance of Python programming is a bigger, more general question in the world of vibe coding and Gen AI and all that. But think of it this way: coding is applying a certain set of rules to data in order to come up with decisions. That's essentially what coding is. I mean, again, I'm revealing my age to you, but when I started out, we learned BASIC as a language of coding, and there were things like Fortran, COBOL, Pascal, etc. When I was graduating during my engineering years, C was the language of choice, and then Java, VB, all of these came, and R and Python are now kind of the flavor of the season, if you might. But this changes. Understanding the skills behind coding are absolutely critical, because then you can even ask an LLM to create your code. But you might have the data, you might have the tools, but if you don't know what rules to give it, how will your system do anything for you? CMT, technical analysis, is all about the rules. What are the mathematical and statistical principles and probability, of course, that applies together to make a decision? That yes, if XYZ factors happen, buy, simply put. If this happens, sell. If you buy and the price goes against you to this point, get out. So these are all rules that you create. There is value of coding, but my 2 cents, it is far more important to learn the first principles. Like I said, I have a couple of AI interns working with me right now who don't write a line of code, but AI writes all their code for them. But they are busy solving problems, and that's what's more important, right? Should investment decisions, I would definitely say never. Investment decisions should never be based on just one way of analysis alone. It's the same story of the six blind men and the elephant. But how, especially, there's always this debate about fundamental analysis or technical analysis. I view fundamental analysis and technical analysis as a pair of eyes. You have been given two eyes. If you lose any one of your eyes, you will still retain about 85% of your vision, but you will lose 100% of your depth perception. Therefore, it is important to understand how to. So, what could the price of something be, or what are the reasons? That is the fundamental analysis. What is likely to move the price of whatever instrument you are interested in? But it's also important to understand how that price is moving. If I were to choose gun to my head between technicals or fundamentals, how I would make the decision is ease of access. In order to do fundamental analysis, you need a lot of data from a lot of diverse sources. Technical analysis relies on price. So, no matter what you do to come up with your intrinsic value calculation, your intrinsic value thesis, i.e., fundamental analysis, I say that you should always do technical analysis at the end of it, irrespective of how you arrive at here is what the price should be. So I would say that technical analysis should be your last layer of analysis before any investment decision, any strategic decision. So I hope that helps. But good, these are very good questions. I'm very happy that we're talking about this. But let me just jump a couple of steps further and then we'll come back. Yeah, these are good questions. Vishwa, Arnav, keep coming. So why this conversation matters to students who are currently in academic institutions that have signed an MOU with CMT Association. This MOU is what we call the Academic Partner Program. So CMT Association has for the past 50 years been the world's foremost credentialing and advocacy body for technical analysis. The importance of technical analysis is getting recognized more and more today with the rise of quantitative finance, of compute. Again, I keep picking up my phone because there is more compute power in this device today than there used to be in an entire room of servers when I was a kid, or when I got introduced to computers at least. And so it's crazy to see where the world is right now. It's just this wild. So to that point, we work with academic institutions because we seek for partners who are looking to help their students build careers and build the right skill sets, especially when it comes to technical analysis, to build a more mature understanding of what technical analysis should be. Again, there is a lot of nonsense information out there in the world, and we are trying to, in a sense, protect the investing public. And you people are going to be the professionals of tomorrow. So the more we can equip you, the better. That's the mission of the organization. So as part of this partnership, and it's a non-commercial partnership, we signed it with the university, and the aim is always to help create industry-ready professionals. The main benefit to students and to faculty as well is scholarships, and especially, and this is exclusively for full-time students of our academic partners, a scholarship to level 1, where while the standard admission, the registration fee for the CMT program is $1,075. For students of the academic partner program, you get access to the program for $295. In India, for better or worse, there is an 18% OIDAR GST as well, unfortunately. But it is what it is. Now, I will hand it over to my colleague Kavita, who will talk a bit more about the investment challenge and the other space we've created for kind of real life learning. But let me just do a quick run at the questions that I can see. and see if I can address any of these. Okay, Arnav, this was a very good question. Thank you so much. I think I've touched on that. My answer is ideally both. And if both are absolutely impossible, at least technical analysis, right? Um, it's another way people say it is that fundamental analysis can tell you what to buy. Technical analysis can tell you when to buy it. More importantly, when to sell. That's an important thing to think about. And selling is when the money is realized, not when you buy, right? Vishwa, does CMT, so does the program help in combining technical analysis with AI to give you an edge? The program, like I said, talks about first principles, talks about what are trends, what is momentum, what is the mathematical underpinning behind that. Once you understand that, and yes, the simple answer is by the time you reach level 3, yes, you can build your own decision systems. Most people who build successful market algorithms are, I can't know, it's not fair to say that everybody is a CMT charter holder, but CMT charter holders who build algorithm or algorithmic decision making or quant systems based tools are typically very robust in the tools that they create. So that's maybe a more polite way of saying that. Agam, so CMT charter holders are not biased towards charts only. Charts, like I mentioned, is just one way of expressing large data. You think about it. In today's world, there are so many other ways that data can be expressed and processed. Technical analysis is about the mathematics, statistics, and probability behind that data. So if you're able to work with that on any system, it makes sense, right? So CMT charter holders, yeah, I mean, there are CMT charter holders who, well, everybody obviously understands and looks at charts as a matter of habit. You could go through your life without looking at charts, but still using the principles of technical analysis for the markets. Omkar, you are a level 3 candidate. You want to work in the debt markets. Can guide on which roles to target. So there are several. And this is a very good question because I, like 20 years ago, used to trade bond futures and money market futures myself. Many of my colleagues have gone on to become analysts for both broking houses and investment management houses. Many have gone on to open their own advisory services. Many have one has become a journalist also, funnily enough, and a couple have gone to work in the fintech space, building tools for folks who operate in the debt markets. So there are many ways that these careers can be targeted. What you want to look at, like I said earlier, is look at the front office kind of roles. In what industries do the debt markets play a role, right? You have obviously the investment management space, the broking space, and then you have the fundraising space. So these are this is the way you might be able to triangulate and look at your options. Because you have a skill at technical analysis and the ability to analyze the markets, that gives you the fungibility to target many different kinds of roles as well. And then you can look at what other skills can you demonstrate to prospective employers that might be in line with what they are looking for. So for all of you, as you are preparing for your careers, there's this old saying that we used to have in-house in Bloomberg that you are never given a job that you are not already doing. A simple way to say that is, if you can prove to your prospective employer that you can already do the job that they are hiring you for, you become far more attractive. Sudhakar, can technical analysis help? Yes. In fact, I have had very fruitful conversations with several senior officials from regulators, from kind of regulatory authorities as well, who use technical analysis and mathematics and statistics based models to understand price movements. And while one cannot determine intent, one can definitely identify behavior that is suspicious. And then when you correlate that against news and against other factors, that helps you to triangulate possible manipulations of markets. That's a very, very smart question. Interesting. CFA argues that technicals can't. It's a see. This is not CFA Institute stand. I must say. Um, no discipline can ever give you consistently predictable returns. If there was some kind of art to it, then there would not be only one. And if there was some kind of a predictability to it, there would not be only one Warren Buffett. There is a lot of nuance, and above and beyond the fundamental and the technical ways of looking at the world. There is also the behavioral aspect of how good a money manager you are. Why is there only one Warren Buffett and Charlie Munger? You know, there are few. And also, this is kind of a spurious assumption, because there are several, and I personally know several people who've built their entire careers and delivered outsized returns, including Ray Dalio and very recently Paul Tudor Jones and all these, who use technical analysis as a very meaningful part of their process. George Soros, for everyone who loves a little political intrigue. Okay, coming back, Satvik. How do you validate your strategies against such environment? Backtesting, baby. Backtesting. The statistical approach could be when market subjectivity. See, and here's the thing, right? You do not ever predict markets. You only learn to react to what happens with a certain degree of probability. All you are looking for when the price is moving is what is the likelihood of this price moving up or down. If your mathematical models tell you that, or statistical models tell you that there is a more than 50% likelihood that will go in a direction, you make a bet. But then you also learn to cover your bets. Wasn't this a Soros line that it does not matter how often you win or lose, but how big you win when you win, and how small you will lose when you lose. That's just one way of looking at it. Swapnil, yes, the simple answer. Technical analysis, the ability to understand the markets as a skill, is valued. Like I said, every front office role, it will give you an edge. Is if you walk up to a hedge fund saying that this is my only qualification, it might not, unless you are able to back that up with consistent results of your own. Let's say you built a paper portfolio based on your understanding of technical analysis in the markets, and that has been able to deliver something that the hedge fund is interested in. Yes, but remember, always it's a series of skills, and there are many pieces. But being a CMT charter holder, having the ability to display not just your edge in terms of the understanding of the markets, but your access to that community. Yes. Almost every major meaningful fund, hedge fund or PE firm I know, either already has CMT charter holders working for it, or they're looking for CMT charter holders, or people are going through the CMT program in the firm themselves. So my wife, incidentally, is head of HR for a PE firm. And I recently met a couple of people who are candidates in the CMT program right now. So cool. I think this brings us to the end of the questions. I'll hand it over to the brilliant Kavita. Kavita, do you want to join the presentation? And then we can talk about the...
Yes. Thank you so much, Joel. And let me quickly take you through the Investment Challenge program. So what is this Investment Challenge all about? So it's an 8-week virtual portfolio management competition following industry standard rules. Now, this challenge is designed exclusively for CMT program candidates and students from CMT Academic Partner Program institutes. There's no limit to how many students from your institute can participate. We have students from more than 36 countries participating in this challenge. Now, what are the benefits and importance of participating in the challenge? Now, it's an excellent opportunity for students to apply investment concepts in practical hands-on environment. Now, this challenge allows you to simulate real-world trading, analyze markets, and sharpen your decision-making skills while building your portfolio and competing with your peers. Now, participating in this challenge is not just about winning, it's about gaining experience, improving your analytic skills, and standing out in the finance community. Now, how do you participate in this competition? So the key dates for the upcoming fall edition of the challenge are: the trial period we are starting from September 8th, and the competition will start from, it will go on for 3 weeks, and the real competition will start from 29th of September, and it's an 8-week challenge, so the competition will go on till November 21st. The results of the competition will be declared on 28th of November. Now, each week, top 3 performers are invited to the mentoring sessions where CMT charter holders share insights and answer your questions, giving you a unique opportunity to learn from industry experts. Now, to participate, you must register on both Discord and the challenge portal, which is Optima. Discord is our official communication platform where you can connect with your global community chat, stay updated, share resources, discuss markets. Now, are we sharing the slide for Discord? Yeah, okay. So you one second, I'll just okay. So this is the official Discord channel, and this is where you need to register. Start here to register, and once you register here, you need to be Discord verified so that we know that you are human and not a robot. And after that, once you enter to, you have to come to 2025 CMT Investment Challenge on Discord. This is where you need to register for the investment challenge. So all these details will be shared with your faculty members and faculty in charge. So any questions you have regarding investment challenge, you can just post them, and we'll just answer your query later. And now over to you, Joel.
You're all invited to join the investment challenge, and the Discord server is a place that you all can join no matter when. It's where Kavita and I often are available to help candidates going through the CMT program with their journey, and you more importantly have access to the other members of the CMT association, people who are already ahead of you in your journey and from whom you can learn. In fact, funnily enough, I've seen some very interesting career opportunities materialize for candidates in the CMT program just by the quality of their interactions with CMT charter holders on Discord. Just thoughtful conversations about the markets. Like I said, if you can demonstrate that you are a thoughtful young person who has a mature way of understanding and making sense of markets, I think there's a very good chance that you will be able to impress prospective employers. So here's the CMT Association website link, pretty straightforward, as is the Discord server. The challenge opens very soon, and also to claim your scholarship for the December exams. CMT exams happen every June and December. So to claim your scholarship for your December exams, you will need to reach out to your professors, and they will need to confirm to us that you are a bona fide student of the institute. To make their life simpler, the first thing to do is go and create a login on the CMT website. You will get in your My CMT page a membership ID. Submit to your professor your name, email, phone number, and your membership ID, which they will then share to us, because that's how we know that you are real human beings and students of an academic partner. And then Kavita will be able to set you up with the ability to pay the scholarship, post scholarship fee, right? So, and once you get the scholarship, you also get access to our digital curriculum, which is in fact how it's this new innovation where we have an all digital curriculum that is very responsive to the needs of the markets and our ability to correct it. And we're also building a lot of interesting functionality into it, which we're testing right now. In fact, I'm doing, like I said, a doctoral program in AI, and a lot of what I'm learning from my program is getting stuffed into this as well, in addition to all the brilliant work that folks who have designed the curriculum have put together. So anyways, that brings me to the end of my comments. What a pleasure. Take care then, guys. Bye-bye.
Thank you. Bye-bye.